Is the competition for retail space in bustling neighborhoods like Soho a sign of a larger trend in commercial real estate? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In New York City's Soho neighborhood, known for its vibrant restaurants, art galleries, and shopping destinations, real estate developers are facing fierce competition for retail space. With a notably low vacancy rate, developers are strategically selecting brands to occupy these limited spaces. This news comes from a recent report by Annika Pergament on Spectrum News NY1, highlighting the challenges and strategies in play for property owners in this highly sought-after area. The scarcity of available retail space in Soho is pushing developers to be more selective about their tenants, aiming to maintain the neighborhood's prestigious reputation. Greg Kraut, Chief Executive Officer and co-founder of the KPG Funds, discussed these strategies on The Rush Hour, emphasizing the importance of brand selection in such a supply-constrained market. This situation in Soho can be contrasted with areas like Kitchener-Waterloo, London, and Cambridge in Ontario, where the commercial real estate market may not face the same level of scarcity, yet similar strategic considerations are in play. As developers in these Canadian cities look to attract tenants, understanding the dynamics in a place like Soho could offer valuable lessons in maintaining a desirable tenant mix. Looking south across the border, the American market often mirrors these trends, with developers in major cities like New York setting a precedent for how to navigate low-vacancy environments. As we continue to explore the intricacies of commercial real estate, the insights gained from competitive markets like Soho can serve as a benchmark for other regions. Stay tuned as we delve further into the dynamics of commercial real estate, examining factors that influence tenant leasing, multifamily developments, and industrial opportunities in both Canadian and American markets. These insights are crucial for anyone looking to understand the evolving landscape of commercial real estate. Downtown rents are experiencing a significant increase as the supply pipeline has dried up, according to a recent article by Rachel Herzog from Crain's Chicago Business. The summer season typically sees a surge in demand for downtown apartments, but this year, prospective renters are finding fewer options available, and rental deals are becoming increasingly scarce. The limited supply of available rental units is driving up rental prices, making it a challenging market for renters seeking affordable options. This trend reflects a broader issue in the commercial real estate sector, where the demand for space is outpacing supply, leading to higher costs for tenants. In the Kitchener-Waterloo, London, and Cambridge areas of Ontario, we are seeing similar patterns in the multifamily housing market. The demand for rental units remains strong, yet the supply has not kept pace, contributing to rising rental prices. This is impacting tenant leasing strategies, as developers and property managers must navigate these shifts to maintain occupancy and profitability. Looking across the border to the United States, cities like Chicago are experiencing parallel challenges. The drying up of the supply pipeline in downtown areas is resulting in increased rental rates, mirroring the trends observed in Ontario. This cross-border relevance highlights the interconnected nature of the commercial real estate market, where changes in one region often reflect broader global patterns. The industrial real estate sector is also facing similar supply constraints, particularly in areas near major facilities like Amazon and Meta. Prime commercial land in these locations is currently up for sale, attracting significant interest from developers looking to capitalize on the strong demand for industrial space. This demand is driven by the growth of e-commerce and the need for logistics hubs, which is a trend seen in both Canada and the United States. In the office and retail segments, the dynamics are slightly different. While retail spaces in high-demand areas like Soho are fiercely competitive, office spaces are experiencing varied demand depending on location and the shift towards hybrid work models. In Ontario, office developments are adapting to these changes by incorporating flexible workspaces and enhanced amenities to attract tenants. Overall, the commercial real estate market is navigating a complex landscape of supply and demand challenges. As developers and property owners strategize to meet these challenges, understanding the nuances of each segment, whether it be multifamily, industrial, or office, remains crucial for success in both Canadian and American contexts. Prime commercial land located near the major facilities of Amazon and Meta is currently up for sale. This significant development opportunity is drawing attention from developers eager to capitalize on the strong demand for industrial space. As reported by Leah March, the nearly 18-acre parcel is situated in Los Lunas, New Mexico, a growing city known for its strategic location and robust infrastructure. This sale highlights a trend seen in both Canada and the United States, where industrial real estate near major logistical hubs is highly sought after. The growth of e-commerce has spurred a need for additional logistics and distribution centers, making such locations a valuable asset for developers looking to expand their industrial portfolios. In Ontario, areas like Kitchener-Waterloo, London, and Cambridge are witnessing similar interest in industrial properties. Developers are focused on securing land that offers proximity to transportation networks and other essential infrastructure, key factors that drive the success of industrial developments. This mirrors the dynamics observed in Los Lunas, as developers in both regions aim to leverage location advantages to meet the increasing demand for industrial spaces. The cross-border relevance of these trends underscores the interconnected nature of the commercial real estate market. As developers in Canada and the United States navigate these opportunities, understanding the nuances of each regional market becomes vital for making informed investment decisions. Australia's commercial real estate market is on a significant growth trajectory, as reported by Mordor Intelligence. The market size, currently estimated at $36.95 billion United States dollars in 2025, is projected to reach $55.46 billion United States dollars by 2030. This represents a compound annual growth rate of 8.46%, driven by factors including the resilience of the retail sector and the strong demand for industrial properties. The retail property sector in Australia has shown remarkable stability, bouncing back after a period of uncertainty. Neighborhood centers and essential services retail are key contributors to this resurgence. These areas are anchored by supermarkets and daily needs outlets, benefiting from stable foot traffic and reliable tenancy. In fact, physical stores are once again outpacing online sales in transaction share, climbing above historical averages. Retail assets are being repositioned as mixed-use destinations, offering entertainment and community engagement opportunities, which is increasing their relevance in both suburban and metropolitan settings. On the industrial side, demand remains robust, particularly for warehousing, fulfillment centers, and logistics hubs located near ports and population centers. The ongoing growth in e-commerce and the need for efficient last-mile delivery solutions are fueling demand for modern, well-located industrial facilities. Limited availability of developable industrial land is contributing to higher rents and lower vacancy, making the industrial sector increasingly attractive for investors seeking stable long-term income. Another interesting development is the growing interest in data centers within Australia. The country is becoming a major hub for data center investment, driven largely by increased digital activity and demand for cloud services. Developers and landlords are allocating more resources to accommodate global tech firms and hyperscale cloud providers. With their long lease terms and infrastructure intensity, data centers are proving to be a strategic focus area, especially for groups with experience in industrial real estate. The investor outlook for Australia's commercial real estate market is positive, with expectations of a stronger investment environment in 2025. Institutional capital is re-entering the market with a focus on logistics, premium office assets, and high-performing retail locations. However, concerns remain regarding foreign investment policies, particularly high state-based taxes that some believe are limiting global investor participation. Additionally, a tight labor market and rising construction costs continue to influence development timelines and feasibility. As we look at the cross-border relevance, the trends in Australia's commercial real estate market, particularly in industrial and retail sectors, are mirrored in regions like Kitchener-Waterloo, London, and Cambridge in Ontario. Similar to Australia, these Canadian cities are witnessing robust demand for industrial spaces, driven by e-commerce and logistics needs. The retail sector is also adapting to changing consumer habits, with a focus on mixed-use developments to enhance community engagement. This interconnected nature of the market highlights the importance of understanding regional dynamics to make informed investment decisions. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.